This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Okay, everyone. How you going? It's Phil Tarrant here. I'm the host of the Smart Property Investment Show. I hope you're well. Joined for our bi-monthly. No, it's not bi-monthly. It's bi-weekly. I always get that mixed up. Check in with the team over at Finney Mortgages, Eva Lorenzons, who is the head broker there. We chat everything through mortgages. It's been an interesting journey over the last, well over half a year, probably nearing a year, having a chat with Eva around mortgages as we've gone through this spate of interest rate hikes. We all know now that rates have remained stable for the August period. There's still a lot of scuttlebutt out there about potentially more rate increases coming through. I think there is one more interest rate or rate meeting while the current RBA governor's in the seat. So a lot of people I'm speaking to are pretty much going, look, I'll just use that as opportunity to put up rates one more time and he'll hand over the baton to the next governor in a more stable environment. Who knows? But I don't think we're at the end of the interest rate cycle, but we're very much so at the top of it. Irrespective, if you read the news, smartpropertyinvestment.com.au, you can see now, you look at a lot of the graphs, we're right in that midst of this inverted commas interest rate cliff with people moving from variable to fixed. Some rude shocks for a lot of people who haven't really thought too much about it. But thankfully, a lot of people have been proactive. They've been chatting with the team over at Finney Mortgages, finney.com.au, trying to work out what they do, see if there's anything else out there for them. So if that sounds like you, no doubt, Eva, you and your team, you just hired a new broker as well.
Yes.
Yes. You're there to help.
Another lady with very strong background in credit. She will know options more than anyone else. So she was also very strong skills in commercial properties. So that could help as well to help, investors that are looking to buy commercial properties.
Good to see you keep growing the team. But there must be a lot of people call you up saying, I heard you on the Smart Property Investment Show. Can you help me with a loan?
Yes, happens a lot. And it's funny because obviously when they talk to me, they actually, I guess, know my voice, so they find that quite funny. So it's
feel familiar. Well, it's good to see you're helping out people with their mortgages. Now, what we like to do, we sort of mix around a bit. Sometimes we get a guest on, but we normally talk about sort of different scenarios which can help people paint a picture and whether or not we're connecting with them. And one of them is an interesting one, and we'll get stuck into it today because it can be a huge enabler, investing in property in this type of setting or structure, but it can also be a real block in time if you don't structure it right. And what we're talking about here very much is investing with someone else, which isn't necessarily your wife or your partner. So like a sibling or a friend. And for many people looking to enter the market, whether they're first home buyers or otherwise, or property investors, actually clubbing up with someone and doing it in conjunction with them can get you into property sooner. It can potentially get you into different types of property and allows you to start building your portfolio earlier. And there's huge upside with that. Where the downside comes, Eva, is at a point in time, if let's say, for example, you do it with your best friend and it works well for a couple of years, you might live in it with them, or you might as owner occupiers, or you might actually use it as investment property. What typically happens is that people's lives evolve and change, and they find a partner, they may get married, they start having children, and then they want to start unraveling what they started to get into the property market, and it become a headache. Do you see a lot of this, Eva?
Yeah, a lot, especially in the last few years. We found a lot of, younger people buying a property with their siblings or, their best mates, often investment properties. And then, 4 or 5 years later, when they get to their 30s, they get married, they want to buy their home. And that's where they realize what they did, was a good idea at the time, but might be a bit of a headache now to buy their home. So that's where we get a lot of those calls when they find themselves stuck. And there's options there. And that's what I really wanted to discuss today because it's not very much known out there what can be done.
So there is a thing called, it sounds pretty technical, Common Debt Reducer Policy, a CDR policy. And we'll get stuck into that. But let's start at the front end, all the reasons why it does make sense for co-investing with someone. Is it easy to set that sort of structure up?
Yeah. It's just as easy as going yourself or with your spouse. Obviously, we need to capture the financial position of both applicants. So it's like a 2 application into one, but it's pretty easy to get into it. Yeah. And that's why people do it. You combine your savings, you combine your income. So instead of doing it yourself, you've got, double power almost to get into it. And it's really allowing people, in their early 20s to get into the market.
Yeah. And what normally happens in that structure? Is it, will most lenders allocate 100% of the debt for the purpose of serviceability, even though you only have 50% of the debt or 50% of the income for the serviceability component? How do they work out the economics of those type of relationships?
Yeah, so when you are assessed, obviously your bestie might be your bestie now, but one day might decide not to pay the bill, or might decide to stop paying the mortgage, or you might, friendship might not be so good anymore, and then suddenly they don't pay the mortgage, so you end up being the one that has to service the whole debt, right? So, and that happens, whether it's with your friend, your brother, your sister, whoever that might be. So lenders need to make sure if that's the case, you would be able to pay the whole debt yourself, right? And that's when people get stuck when they want to buy a new property, because the bank will say, well, okay, your friend is paying half of it. But if they decide not to, you will have to pay the whole debt. So they assess that whole debt as if it was yours. But nicely enough, they only put 50% of the income if you get income from that property. So it's really double disadvantage there when you want to buy your next property.
And this is a de-risking exercise, by the way. How often do you see these things going wrong when say two friends decide to invest together? Usually it works out, or it can get messy. No doubt you need proper legal agreements and stuff in place.
Yeah, that's right. Most of them would definitely have legal agreements, especially if their savings wasn't the same at the time and they bought the properties in, with different percentage. And yeah, it does happen. And I think it does happen often when their life situation changes and they get married, or one of them want to sell the property, when things change. I guess that's where the problem comes up.
Yeah. And it's good if you're going into these type of arrangements, you need to know that you've got to be thinking about what the exit is and how being co-connected with someone can minimize choice and options into the future, because there will be a point in time when you need to disentangle. Hopefully at that point in time, the simplest way to do it, if people want out, is that you sell it, right? And everyone realizes their deposit back plus any capital growth, and that can all be done on a per percentage basis on contribution into it. But it can get messy, particularly when there's emotions involved. If other people's circumstances don't necessarily meet yours, if you're investing together, or there's sometimes a layer of jealousy that can happen as well. Let's have a chat about that. Let's go to a quick break. Stay with us. Back in a moment.
Crush the burden of rising mortgage repayments. We understand that managing your finances can be overwhelming, especially as interest rates continue to rise. With access to 70 plus lenders, our team of specialised brokers will find the best rates for your specific needs. Count on us to secure a lower rate swiftly, giving you the confidence you deserve. Book an appointment with one of our experts today to protect your financial well-being and secure your future. Call us now at 02 8866 2444 or visit our website at finny.com.au.
Welcome back. It's Phil Tarrant from Smart Property Investment, chatting with Eva over at Finny Mortgages. So we're talking about a common debt reducer policy. So this is the basis that when you're younger, you choose to enter the property market with, let's say, a friend or a colleague. Let's call it a friend, because you can't do it individually. But if you club up together, you're going to have the ability to save the deposit and have the serviceability to buy an investment property, get into the market earlier, hopefully birch as well, and get the upside of the commercial capital growth on that. What we're talking about is that when life and circumstances change, hopefully for the better, but sometimes for the worse, how do you go about unraveling that? But there is a thing called a common debt reducer policy, which allows you essentially to keep the asset but not be liable for 100% of the mortgage. Is that correct?
Yeah. So that's pretty much what would be, I guess, common sense and what people would believe to be right, I guess. You've got a property with your brother, it's 50-50. Well, it should be assessed 50-50. So it seems like, it's a normal thing to do in common sense, but that's just not how it's assessed by many banks or lenders. And I had a case recently where a client bought a property with his brother over 5 years ago in Sydney, in the eastern suburbs, and they've got quite a large loan of 1.2 million. So that went all well. My client got married. He bought a home. They bought a home with his wife. That went fine as well, because they had quite a bit of income and servicing capacity. But they got stuck when they decided to buy more investment properties. They went to the bank, and the bank said, sorry, just not going to work anymore. You would have to sell that property you've got with your brother. And that's where it got into a bit of a family drama, because obviously the brother didn't want to sell, they didn't want to change banks, they didn't want to do anything. So that's where it gets quite tricky. And so this client came to us as a second opinion again. It just went to his lender. That didn't help. And then we found, he found out that policy, if we moved bank to get his investment property, could really open up new doors for him and buy properties. So that's what we did. And on top of that, not only he could get enough servicing to buy an investment property, but we were actually able to get equity out of the property he has with his brother. So his side of the property, or his portion of the property, was accessible to him to get equity out. So it's a huge difference from, sorry, you can't do anything, to, yes, let's move that property, get cash out of that property you have with your brother, and invest with your wife. So that's a huge difference between lenses of what you can do when you have done investing with someone outside of your spouse, I guess.
So the brother who got married was able to take his share of the equity out of the property?
Yep.
Yeah. So does that change the whole LVR position of the whole property, or is it just for his percentage of it?
Yeah, that's what you can only access, I guess, 80% of your share of the property. And that's what we did. But the property has grown quite a bit over the years. And obviously, you can expect when they have a $1.2 million debt that the property is worth quite a lot. And he only needed, 150K or so to keep investing. So yeah, he just accessed, his share of his equity. And the brother didn't have to, to sell the property, didn't have to do anything really that would affect his lending. So
could the brother who wasn't getting married buy out the other brother? Did they consider that as an option?
They could have as well. The issue is none of them really wanted to either sell the property, and his brother actually couldn't afford to keep the whole property himself.
Okay. So he was stuck at it. Did it turn to a big fight?
Yeah, it was a bit of a drama, because I spoke to both of them at the same time to see what could be done. And well, look, it's not, sometimes it's not super pretty.
Yeah. Well, were they yelling and screaming at each other?
Yeah, a little bit.
Yeah. So in many ways, a mortgage broker is a counsellor, right? So, yeah.
A little bit. Yeah, that's a bit of that. But look, we got it done. So it's a great outcome there for him to be able to not only just invest, but also get cash out, so they didn't have to use any of their savings, and they could keep the savings to pay off their home loan.
Yeah. And did the brother who's not getting married cash out did he keep all his equity in the property, save it for a rainy day?
Yeah, look, it just doesn't really need it. He's happy with just that property. Just a single guy. He's renting in Sydney as well. Just happy, I guess, that way. He just really didn't want to sell the property.
So is the relationship fractured, or are they friends again?
I think they're fine now that it's been sorted, but I guess it's easier when you're, I guess, brothers, you, I guess, have to stay in touch in some ways. Then with friendship, it can be a bit harder, I guess.
Yeah. And this is things do change, right? So you need to be able to, and it's good that some lenders have this view for it all, because having to sell that. And if it's $1.2 million loan in the eastern suburbs, it must be a pretty reasonable property. And no doubt it's had some good capital growth over the years. Did the brother who's got married wife get involved and cause problems? Or
No.
She wasn't too involved?
No, Phil. Sometimes the women don't cause problems.
That's not what I'm implying. I was just because when it's okay when there's two, but sometimes when you put
she stayed out of it completely.
Yeah, that's pretty smart business, that, I think. Because families often have a way of working things out. It's when you when you put in but this is the point, right? You just don't know when things change. A lot of people don't handle change well, and when you start talking about money and livelihood, if they feel as though they're stuck in that property, they can't move ahead as a couple because he's got cash tied up in that, and it's illiquid. You can't get any value out of it. That's what causes problems. So it's called a common debt reducer policy. So let's chat about that. We'll just go to another break. Stay with us, back in a moment. And welcome back, Phil Tarrant from Smart Property Investment, chatting with Eva at Finney Mortgages. So common debt reducer policy. So how does it work simply? Is it just we're only assuming 50% of the debt? Is that pretty much it?
That's what it's basically what everyone would think should happen is you bought a property 50-50 with somebody. Well, you should only be liable for that 50% in terms of assessment anyway. So yeah, that's pretty much what it is, instead of using 100% of the debt in case that person you invested with doesn't pay its share. I think it's important to note as well that it's also applicable if you and your partner actually invest separately. And that does happen, I guess, more and more, especially with people with high net worth or people that maybe met late in life. They just do their finance, I guess, separately. And that's also a way to do it when they have maybe their home together, and that home debt will be affecting what one person could invest in. So that's also applicable in that space.
So the inverse of that. So if you come into a relationship with assets and you choose to buy, say, two people come together and with their own separate assets, they decide to get married. They've got debt against their individual assets, but they choose to buy a family home or owner occupied residence together. They're not going to assume the debts on the 50% of the debt of the person, stuff that's come in. All right. So that again is just practical and
yeah, it seems pretty practical, but it's really not done by many lenders. And I think it's a surprise for everybody when they get into that situation to learn that. And I think it's important that people know there are lenders that can help with that.
So I'm not in the business of plugging lenders. I do like lenders, by the way, and have a relationship with a lot of them. But what lenders actually have a common debt reducer policy?
Yeah, so mainly the majors, Westpac and St. George do that pretty well. Yeah. CBA a bit, Macquarie, AMP, ING as well, but not so well. A bit clunky in some ways. So yeah, it's not many.
Yeah. And you think like it would be a great way to generate business by doing it because no doubt it all comes back to the level of serviceability you have. And I imagine there's LVR considerations around this, right? They're not going to allow you to jack it up to 90 or 100% LVR. No. I imagine they need lower LVRs for them to have satisfactory.
Yeah, the same policies apply, I guess, to whoever that might be. But yeah, I guess it's great business for them because most of the time they would actually not only get that new purchase that people want to do, but the whole lending that is across one brother, let's say, and the other, because it all has to be with one bank. So great business for them, and just I guess a common sense policy almost. That's what should be applied, but it's not. Yeah,
well, common sense doesn't always prevail when it comes to lending, and to be fair, lenders are in the business of risk, right? Lenders lend out money. They want to get their money back with a little bit extra on top of it. That's the business of lending. So makes sense. But this is where you see innovation around the edges, in lending. And it makes sense. You know, if you have a particularly high net worth individuals or more sophisticated investors, they might invest with other people and they might have assets with other people, whereas commercial or residential, and they're going to have their own investment, own direct investments as well. So, you know, not to be curtailed by someone you might co-invest in on 20% of your overall wealth creation, but that to impact the other 80% that doesn't connect with them, it makes sense for this to take place. So as a mortgage broker, it's best to know this pretty early on, right? That this is the structure. I imagine if you go directly to your bank, they're going to go, no more for you.
Yeah, that's right. So yeah, look, it's not, I think, most brokers would know that very quickly when they hit that wall, I guess, with a lender that doesn't do it. But most lenders, I guess, they just, obviously apply what's applicable to them and that's it. So they would not tell you, hey, FYI, I can't do anything, but you could go there and do it very well.
Yeah, they don't like losing business. And I guess also if you've got your loans cross-collateralized, this becomes even a bigger problem, right? No. It's pretty much over, right? Like, and again, you think you're making the right decision at the point in time, and you're probably making the right decision at that point in time for what you know then. But there is, there's this famous thing about known unknowns and unknown unknowns. There's a lot of unknown unknowns when it comes into it. You just don't know. Like you probably know things are going to change, but you're not going to know how they're going to change. And you can't make your decisions today purely with the lens of what might happen tomorrow. It's a really tough cadence of getting it right. Like you got to make the right decision for today, but having optionality for tomorrow. And you need to know what are those mechanisms of optionality. And I would say if you're a property investor, cross-collateralizing your loans is probably a no-no. It might make sense right now. You might help you get into a property today because you can, get the serviceability or the equity. But if you're thinking about tomorrow and the next day and the day after that, it can potentially stifle you. At least I think it's a great initiative for younger Australians who are struggling with affordability to club up with someone and co-invest. I think it's a great way to accelerate yourself onto the market. And if you're in the market, you make the right decisions, you can get a huge head start. If you co-invest with someone for 3-4 years before you have the ability to do it yourself, you're going to at least get 50% of the upside of the the equity increase or the capital value increase in that property, which you wouldn't get. When you start doing the math, so it makes a lot of sense. LMI can be a great enabler. A lot of people go, I don't want to pay LMI because it's another insurance. So, I'll stay out of the market until I can save the deposit. But if you can accelerate your way onto the market by a couple of years by buying good assets and investments, that can be a great way for creating wealth. So you got to think about what your chapter 1 looks like. You got to have an eye towards chapter 4 and chapter 5 and maybe what chapter 10 is at retirement. So make the right decisions for that today, but work out how you can look for enablements. And there's a handful of them there. Do you get a lot of co-investors coming in, Eva, saying, hey, look, me and my brother want to do some stuff together?
Look, it's not the majority.
Two sisters come together. I'm being a bit sort of, there's more female investors than male investors.
Brothers and friends names, actually, most of the time. Yeah. But, we do see quite a lot of it. And I think a bit more last year or two where it's been harder and harder to get servicing. And, I guess young investors or people just starting, they just want to get in, but they wouldn't be able to do it on their own. So.
Yeah. So look for those advantages. Speak to your mortgage broker, and the team at Finny Mortgages want to understand is ready to go. Eva, what do people need to do if they want to chat with you and your team?
Just log in on our website, finny.com.au. There's a page there where you just need to put your name, number, email address, and we'll be in touch to book an appointment with one of our brokers. And we can have a look at the situation and find a solution today or for tomorrow. But we'll definitely have a good look.
How do you spell Finny?
FINNI.
FINNI.com.au. Get in touch with the team. You normally find a solution for most people. There's not very often you get stuck, right? You guys find a way?
Yeah, look, sometimes it's not doable right now. But, we can tell them at least, look, do this, this, and this, and then come back to me and it will work.
Yeah. And for a lot of people, that's a good strategy. Just wait and get your stuff sorted out, come back in a year's time. And just having that pathway and understanding and knowledge can be a great way for you to shape your investing career. So Eva, thanks for your time. Thanks again. Your brokers are going through my stuff right now. They're nearly at the end of it. That's quite an onerous and arduous process. So, once we've got everything, as I mentioned beforehand, I'm moving a lot of my stuff from P&I to interest only, just purely because I want to sort of minimize the, improve the cash position, the cash flow, good assets that's still growing, but, I don't want to be playing those principal components, seeing that interest rates have gone up. So I've asked the team to go about sorting it out for me. So once we're done with that, I'm going to come and share it all and the different lenders that we're working with. You know who you are if you're doing the work right now. So all good fun. But we're nearly at the back end of it, and I look forward to getting all that sorted out. So watch this space. We'll do that in our upcoming installment. Remember, go and check these guys out, finny.com.au. If you haven't thought about your home loan for some time, I'd highly recommend you do, because your rates would have gone up if you're on interest only. And if you're nearing the end of your fixed period for your interest rates, get onto it early. As soon as you get onto it early, you'll be able to give more time for finding optionality, and optionality is key. Remember to check out smartpropertyinvestment.com.au, social media, Smart Property HQ. There's some other cool stuff happening in the world of property. I'll be able to share that with you shortly as well. See you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.